Saeed here, sales manager with MoneyWise Mortgage. Wanted to welcome you over to our video on credit. Now, this video consists of two parts. The first part will be the breakdown of your FICO score. The second part will be tips on how to improve your score. So with that said, let's begin. The first part that we were talking about was how your score actually breaks down. Now, 35% of your score is your money, some credit, and you're going to pay them back at a later date. And that accounts again for 35% of your score. The next part is your amount owed, which is 30% of your score. With these two units, that's 65% of your score. Now, the amount owed, easiest way is to give an example. You have a credit card and it's $10,000. If you owe $2,500, then you're considered you're utilizing 25% of your credit. Now, typically a bank or your FICO score will allow up to 25%, and there's different school of thoughts on this. Some people might tell you 25, 30. I'm more conservative, so I'll tell you 25, and your score should be fine. Anytime you go over that 25 to 50 to 75% range, you're going to get you'll see something on your credit report saying proportion of credit to available balance inadequate or something of that nature, which means is you're highly leveraged. And anytime you're highly leveraged, the bank looks at that and doesn't really like that, and will your FICO score will reflect that. Now, when you're trying to improve your credit score, you got to make sure you got to put your time where where it's going to have the biggest impact, and focusing on your payment history, which making your payments on time, and the amount owed is really important. The next three parts of the credit score that only account for 35% is the length of credit. Now, a lot of times people see these credit card zero interest for 6 months, and they'll close out or they'll transfer from their established credit card that they've had for years and years to get this introductory interest rate. Now, what happens is by doing so, especially if you close out your established credit card, it's going to lower your score, because what you're doing is you're showing you have a card there that you've had for, let's say, 5 years, and now you're going to cancel or close this established credit where it demonstrates your ability to pay into a new account that they don't know if you're still that creditworthy. So having established account is so much more, it'll benefit you a lot more than having these new accounts, even though you're getting the 0% for 6 months. And the last two parts are the types of credit you have. A mortgage account on your credit is a lot better than a place like, not picking on them, but a place where you can rent to buy your wheels or appliances and so forth. So the kinds of credit accounts for 10%. And finally, inquiries and new accounts account for 10%. The fewer you have inquiries, and that would be health membership, a cell phone company, and so forth. Those will all be considered. Mortgage companies will be considered inquiries. The fewer those, the better your score would be. Now, the next part would be that would be part one. The next part is tips on improving it. Now, I have 7, and I'll go through these fairly quick. The first one is 25% or less utilization. That means if you have a credit card, and again the balance is $10,000, or available balance is $10,000, you only use 25%, which is $2,500. And if you have a different amount, just multiply by 25%. Anytime it's higher than that, your score will be negatively impacted. So if you have a question that usually comes up, I have one credit card and all my amounts, and I only use one credit card, but I have 5 altogether. What I would say is I have one credit card that has a balance of $8,000 and my max is $10,000. I would rather spread those out over 4 cards so we can maintain that 25% credit utilization. Next is pay your bills on time. No secret to that. The best thing will probably be set it up automatically now with online banking. All that stuff can be set up. You can be on vacation or wherever you're at, and stuff is being paid on time. Third, keep established trade lines, even though the introductory interest rate might be good on these new cards. Especially when you're buying a house, having these established credits is always a good thing. The bank knows that you keep stuff for a long time, or credit accounts for a long time, and you have the ability to pay it. Fourth would be limit your inquiries. You're allowed, typically, most people would say about 2 trade lines, 2 inquiries a year without being dinged. So anytime you go over that, either you're going to lose some points. But the whole point of credit is to obviously use it. So if you need to use it, you need to use it. But try your best to limit the inquiries. Next tip would be only typically having 3 to 5 trade lines open. Now, with that said, why 3 to 5? Now, if you have 1 or 2 accounts open, you can't really, you only have a limited number of opportunities where the bank or the creditor will see that your ability to make payments. So, only having 1 account, if you are, doing well on that account, it doesn't really give you, doesn't show that you can actually handle a lot of credit or some more credit. So 1 to 2 accounts is typically, you need a couple more. Anything more than 6 or 7, what happens is, especially if you have a lot of available balance on it or available credit on it, if something were to happen, a loss of job and so forth, you are more, you're considered more of a risk, because you can very easily just take out all the money and declare bankruptcy. I know most people are not going to do that, but to the bank's eyes, they would like to see 3 to 5 accounts where it shows on one hand that you have the ability to make payments on time because it's enough accounts that they can see, and on the other side you don't have access to a lot of credit where if something happens, you won't take everything out and try to walk away. Next is dispute any unauthorized credit inquiries or charges, and that's typically for people that name their children after themselves, juniors and seniors and so forth. What happens is when you're establishing your credit when you're younger, you typically, obviously have your father's name or your mother's name, and you have the same address. And a lot of times accounts can be confused where parents' accounts might be on their children's accounts and vice versa. We had an example of one person. His father had bought a mobile home, and he's 19 and had this. He was 23 and had this. It was an $80,000 mobile home on his name, and we never knew about it until we actually saw his credit and ran it. So making sure you run your credit and more of a preventative medicine, and making sure what's on there is accurate is really important. You don't want to get to the closing tables and actually find out that that RV is actually under your parents' name, but it shows up on your account, again, because it's a junior. And the last recommendation is let time work its magic. There's nothing really magical anyone can do. The whole point behind credit is you get an account or someone lends you some sort of credit and you pay it back, and your ability to pay it back over time. So let time work its magic. There's no really big secret to it. So I hope this video was informative. You enjoyed it. Please click around. There should be more videos around. There's a part where you can subscribe. You can forward us to a friend. All that good stuff. So, and if you don't like this video, you didn't think it was informative, forward it over to someone you don't like. Right? So best wishes, and I hope you get to watch one of our videos soon, and hope to see you soon. Bye.